Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be taking a look at the S&P. Now the S&P is creating a situation that only happens every once in a while, but a big weekend gap. Now with the weekend gap, first off, one of the things that we were talking about before was how selling up here, in one of the previous videos, maybe a video or two ago, made a lot of sense. But now we've had a cycle all the way down here where those sellers are probably taking profit. Now, we don't necessarily know where that's going to be, but there are a few things to keep in mind when we're looking at these big gaps. And that's really what this video is going to cover, are the things to keep in mind when it comes to gaps. First off, when it comes to gaps, if you're not familiar with what a gap is when the market closes here and opens here, right? That's the simplest way to put it. This is a gap. Now, sometimes a gap can be one tick. Sometimes a gap can be several hundred ticks. It just depends on what's going on. But in this case, this was a fairly large gap. And this would be considered an outside gap down. Now, the reason that is because if we look at that entire day's price action, that's the low of day, that's the high of day, we opened up outside of that day. So this is an outside gap down, right? Same thing would be true if we opened up here, that would be an outside gap up. If the market opened up inside of the range, then it would be an inside gap up or down. So now that you know what gaps are, if you needed a little bit of a refresher, when we have an outside gap down like this, the one big thing to keep an eye on is that first candle. Now I'm looking at a 15-minute chart. You look at a 5-minute chart, an hourly chart, doesn't really matter. The important part is paying attention to that first candle, that first, 15, 20, 30 minutes of trade, even an hour of trade, because that's where you're going to see a huge amount of sentiment being created. The highs and lows of that candle are going to be a big deal. One thing that I like doing is going in and adding one of our fibs to it from the exact high and the exact low of that candle. And this is what I call our actual risk fib, because that adds on, oops, all the global drawing objects. Set that to 60 minutes. There we go. This adds on all of the 100% deviations. So this is the top, this is the bottom, so 0 and 100. Then you have basically plus 100. It's 200 in here because we're starting at 100. So 100, 200, 300, etc., all the way up, just singular deviations higher. And these zones, when you're looking at that big gap, and you're monitoring where those deviation areas can be, they create monstrous levels of support like we had here. So that's number one to pay attention to. And you have a big gap and then a very large candle, especially with a large candle. That candle becomes a big area of interest. The highs and lows of that candle are a zone of interest where you can kind of think of it as its own range, where the market tries breaking out of it, tries going down again, fails. Now we're back inside of it. Buyers come in, try the other side. Maybe we see the same thing here. But one thing's for sure, the next part of this is that almost all, and actually I think basically all, gaps get filled. Big caveat though, all gaps get filled in an undenoted amount of time, right? In an undefined amount of time, all gaps will fill eventually. Or most of them. So the problem with that is that, well, if we know that all gaps fill eventually, usually within the day or so, that the likely objective for buyers is going to want to be to rotate up, right? They're going to want to fill that gap. They don't want a bunch of unfinished business here with an open price gap. But it could fill yesterday. It might not fill now, and it might come back a year and a half from now. That's the problem with saying, well, all gaps fill, so I'm just going to go for the gap fill. You got to be a little bit careful with that because, yes, all gaps do fill at some point. Might be a little longer than you wanted it to be. So pay attention to that gap fill because that's going to be a massive objective. When the market reaches that objective, that's going to be a huge decision point. Do the sellers come back in and slam the market down and continue this bear trend that we've been seeing over the past few days? Or do the sellers try, fail, and then we break higher and use that as a launching pad to go back up to the all-time highs again? So that's something to really pay attention to when you're looking at this type of movement. But right now, it's pretty obvious that sellers tried. They had a beautiful breakdown, had really good follow-through, and then just kind of fell on their face. When the market came back, held as resistance, pushed back down. The rest of the sellers looks like they took their profit given that response. Came back up, sellers tried again, failed. Sellers tried again, failed. Sellers tried again, this time the weakest response of them all, and you can see they gave up. So the next time this comes back, those are probably sellers who were in short from before. Maybe they didn't take their profit on this drive down, or maybe they got in over here or didn't have a chance to take profit. Now they're getting out at break even. And as soon as they get out at break even, nobody's left to hold the market down. and it goes flying higher, and our next objective is going to be the gap fill. So those are a couple major things to take a look at when you're looking at these big gaps. Typically, these types of gaps happen over the weekend, but there are those occasions where they'll happen in the middle of the week when there's big news or something like that. Those are a little bit different. Those very, very frequently fill quickly. Markets don't like midweek gaps like that. Weekend gaps are a little bit different. This can take a little longer to fill in. You can see it's already going on the second day, and it has yet to fill. It's trying, but it hasn't made it there yet. Either way, though, a couple things to pay attention to when you're looking at this overall movement, when you're talking about gaps and big gaps, especially when the big gap is coupled with a big candle. Then it shows some interest. But that's going to do it. So hopefully you found it useful, interesting, something, you know, that you can add to your tool belt. Outside of that, though, that'll do it for this one. I hope you had a great day of trading. If you have any questions, shoot me an email, jbrink@slingshotfutures.com. Until the next one, we'll see y'all then. Thanks.